So it's an interesting set of data points because the last 1200 points of rally for the index has led into different textures. So, let's first understand the premise of the the setup which led into this kind of a ferocious rally for the index. We were into a zone where the 5 months of consecutive downtrend was there for the Nifty, ending the month of February 2025. We looked at the oversold nature of indicators. RSI was oversold, market sentiment was oversold, the market breadth was extremely oversold, and the most important part, the two major asset classes which have a direct impact or a negative correlation with respect to our markets, both of these asset classes, dollar as well as Brent crude, started to go into a corrective mode. Now this is interesting because this data point reflects or goes back again to that zone where in 1996 we were at a point where there was a 5 month of consecutive downtrend. Now as you can see in 1996, when we seen 5 months of consecutive downtrend on the index, post that we saw almost a 2 to 3 month of recovery for the markets. This time around also, so far we've gone through the first month of recovery. We are in the mid stages of the recovery, and whenever the recovery shapes up, it manages to break past about the previous month high at least, which is closer to 23,800 mark on the Nifty when you look at it as a like-to-like comparison. The second chart is also very interesting, where we look at the market breadth indicator or the sentiment indicator, and over the last few weeks, how the data has changed in terms of the market breadth. So this is the zone where on 4th of March, when the indices made a bottom, at that point of time, most of the market breadth indicators like the mid cap 50 stocks, small cap 50 stocks, and the Nifty 50 stocks, they were trading almost 88 to 90% of the data were trading below their 20, 50, and 100 moving averages. Those are steep numbers. Whereas the number now emerged. So currently we are looking at a point where the average number is around 30% to 50% for the the mid cap, small cap, and the Nifty 50 index, where the data is now come back into. So that again indicates that we are looking at a point where the markets have gone to a bit of a neutral territory. Then we look at the second bit of composition in terms of market structure trends. Now this is a very interesting chart for Nifty 50. This indicates that over the last 3-4 years, we've gone through phases of market correction. But the trend line which shapes up for the index, as you can see that historically also when the index went to a similar kind of a correction, when the index went to a correction, the markets went to a corrective zone. The trend line managed to break, and then post that trend line breakout, we saw the index retesting the 200-day moving average line. In this case, that's again at 23,800 to 24,000 mark for the Nifty. And the last data point is again very interesting. We look at that whether we are too much dependent on the banking index only, where the bank Nifty has made a new high. But this time around, the change is that there are other sectors which are offsetting the move, which are stronger than banks. You looked at the PSU sectors, metal stocks, energy, media. There are so many sectors which are now looking very attractive. That indicates that we have much more room on the upside to go up higher for the indices.